All right, so we went into options expiration about as high as you can get at the highest point that we've seen, literally like a few minutes before expiration. Now the question is, what do we get going forward? Now that we're through, what do we get going forward, going out of expiration? So we're going to break that down. There's some, again, we've talked about cracks in the sidewalk. We're going to look at a few more here today. But we're also going to make the distinction between any weakness we might expect over maybe the next few weeks versus long-term expectations, and why any intermediate pullback would not be a concern whatsoever. So we're going to talk about that as well and why. And we're also going to talk about, in fact, it would be a really good thing. We're also going to talk about, for our trade idea stock, that's giving us an overbought cluster at the beginning of its own intermediate run, and talk about how to trade that. So let's go ahead and get started. Today is Friday, August the 21st, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the Market Forecast Indicator and look at what we got here. We got another overbought cluster. This time the near-term line not nearly as high, but the near-term line is beginning a new near-term run. So yesterday, with the open to the downside, even though we closed near the high of the day yesterday, we still got the near-term line, below 50. That constitutes a near-term pullback. And then today's bounce, especially with the momentum line really taking off here, getting and again very very small range, but getting up into the upper reversal zone. That is a cluster, an overbought cluster. Again, it's one thing to get clusters over here. This is ideal. When you get a cluster over here, it's like, all right, here we go. But getting clusters more than 4 months into an intermediate rally, that doesn't necessarily mean that we're going to drop like tomorrow. You can see over here we got clusters and we kept going up. We weren't 4 months into it. We were probably a couple of months in, or maybe 2.5, almost 3 months in. This was actually a 4-month intermediate run here. But so you can see we get them. It doesn't necessarily mean we're dropping on Monday, but it does mean, again, reward potential going forward does not match the risk that we have. And just to kind of give you an idea, here, let's see here. Do I have the high? Here, give me 1 second. Let me make sure I get this high point to today's high, since that's the actual high point there. All right, so the risk right now, when we're talking reward risk, you remember the risk is a move from 0 to 23%, because it doesn't take much to get that. And now that's so far below where the moving average is that would be that would be a pullback. Like usually it's not. Usually when you're above the moving average, it's noise. Like that was a 23% retracement. This one was, that one was, that one was, that was. These were all 23% retracements here, and it didn't cause any kind of. These weren't pullbacks. They were just noise, right? The near-term line dropped, pretty low. In this case, it got into the reversal zone. In this case, it got into the reversal zone, and this one didn't. But the momentum line hit an extreme low. But we always popped up off of here. The next time we hit the 23% retracement, and you can see the only time out of all of these that we actually hit the moving average or went below the moving average was right here. That's not going to be the case this time. We're going to be, by the time we hit the 23% retracement this time, we're going to be well below the 30-day moving average, about as below it now as we were over here. But this wasn't a 23% retracement. This was like a 38% retracement at the time here of that intermediate rally that we had. So it's going to be pretty significant, and so that's the risk, right? So the reward, does it match that? That's a what, 33.99 to 31.14. That's 285 points. That's a 285 point drop, and there's nothing in between, typically between 0 and 23, that's really significant support, right? Usually that's your first layer of relative support, and of course your strongest support's at the 38% level, and then you have another layer of support, kind of a minor layer in the 50% level, and then bigger layer at the 62%. So So the 23% is kind of, is your first support level. There's nothing in between. Like, we can drop down there, as we've seen, in a couple of days or in 5 days. It doesn't take very long. It just takes, here was a couple of days, that was a couple of days, that was a couple of days. It doesn't look, it seems like it would take a long time to drop there because we're going so slowly right now and there's such a wide gap. But you remember, the wide gap is a function of how big this rally has been. That just means that the pullbacks are going to be in context of the rally. So as big of a pullback, I mean, that was a pretty significant pullback because we rallied from, look where my cursor is, compared to that low point, we rallied from here up to there, right? This go around, the end point's nearly the same, but the starting point isn't up here. So you follow the horizontal line all the way to the right. That's where the starting point of that last bullish intermediate run was. The starting point for the current bullish intermediate runs, obviously way down here. So much bigger move, and now instead of a 38% retracement to get to this point, 3119-ish, 3120-ish, now it's only going to be a 23% retracement. So it's not going to be it's not going to be like, oh no, we're going to fall off a cliff. It's just going to be, but it's going to be uncomfortable because people aren't, we're not accustomed to the markets pulling back. When the markets pull back, we get markets in turmoil episodes. Like, that's why we go 5 months now. I mean, the typical intermediate trend's 1 to 3 months. Now we're going 5 months because we can't handle. This is probably when we should have had a pullback right here. But we can't handle that because the market goes nuts and people go haywire. And now we're heading into recession and whatever. We're going to retest the lows, and it's like, no, we're still in a nice good trend. And when we get down here, if and when we do get down to 3120-ish, people are going to go pretty nuts. It's going to be, there's going to be reasons why, and then the markets and all of this was all fake and it's all Fed induced, and all the bears will come out and say, see, I told you so. Remember, they were kind of saying all the way up in here, but now they'll be saying, I told you so, and it's like, well, you told us so about 300 points ago, or 600 points ago. But that's what's going to happen when we're sitting at 3120, especially if we get down to 2940 into this area. But if we get down to 2940, then market scholars are going to know, we're going to be looking at that with salivating, looking for opportunities for new directional bullish trades, where everybody else will be talking about how we're going to tank all the way down to here. I guarantee that's going to be the tenor in the markets from the financial media and from a lot of what you'll hear on Twitter, because again, that's when the bears will be out. The bears really get loud during the intermediate pullbacks, but it will be nothing more than that. In my portfolio management class I taught yesterday, I shared a chart that shows why that as bullish as we've been, that we are more likely to be very bullish going forward from here, even with a pullback that might start us off first for the next 18 months, potentially to 2 years. And I've gone back to other periods that are very, very similar. So again, check that out. It was a very lengthy discussion and very helpful in terms of where we are in risk appetite right now. It looks like we are extremely overbought and extremely oversold in the risk in the safety trade. And the opposite's actually true. Again, we are up here. The 50 some odd % gain that we've had is a function of a 34% drop in 4 weeks. That is it, right? If we were to take this out and just ride this linear regression forward, like if I were to do a linear regression going forward here, let's just say in 3 years, but if I were to draw a line coming forward from here, I mean, look, you can kind of see we are not overbought. I mean, we are in the upper half of the chart, but we are hardly extremely overbought, like above the second standard deviation line. So again, the rally is a function of the drop, and part of this drop is a function of this parabolic move that we had, or this good bullish rally that we had here. But I mean, look at that steady trend, bullish trend. We're above it. That we've recovered. We've kind of broken back above it here, but we are hardly to the extreme, which means, we might get a little bit of a pullback down in towards that midpoint, but the trend is clearly to the upside, and we've clearly got plenty of room to go before we get parabolic like we did over here. Like on January 26th of 2018, this is a 3-year time frame. So if I try to do something similar, January 26th of 2018 to January 26th of 2015, right? If I do a similar 3-year time frame, you see that's extremely overbought. And that's when we started this stealth bear market that I've been harping on for so much, that started there and really kicked in the gear in September, October. I know I repeat myself a lot, but I'm trying to make that point, make clear that point. That's what it looks like when we are extremely overbought. That is not what we look like right now. Same 3-year time frame. That is not like what we look like right now, right? So again, the rally is a function of the pullback, and so yeah, we know we are the cluster is a sign that we're gonna pull back. We talked earlier this week that it's likely, and we've talked for the last week or two, that it's likely we don't get any kind of weakness until after expiration. Today was expiration, so now we start looking for that more clearly. You can see that the Dow's quite not to that 100% level, and in fact, the Russell's been dropping on a day where the Nasdaq also gets a cluster. The Russell is dropping, so that might, and not only that too, the equal weighting is dropping. This is kind of a there's got very strong correlation after getting its own cluster, a strong correlation to the Russell. But you can see we've been dropping. The breadth has been getting weak into this expiration, and we've seen typically weakness coming out of expiration in prior expiration cycles, except for it looks like this one. We gapped up and stayed up in that expiration cycle, but all the other ones, we come out of expiration with at least a soft bout of weakness. Even this one, we had 1 day of weakness before we pop back up, and of course February is where we kicked it off. So we'll see if that ends up being the case here as we head into a very important September and October, considering the election cycle that we're in. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us 2 things. Number 1, that you liked our video, and number 2, that you want us to do another one on Monday. It's a quick way to give us feedback. If you like our videos and you want to let us know, you can do it with 1 click right now while you're watching. Just click that thumbs up icon. If you don't like our videos, of course, you don't have to click on anything. Also, too, comment down below on anything. Any questions or comments you have about anything we talk about in the video tonight. Let me know down below. Join our website at marketscholars.com. There's a link popping out right there, top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. My handle's up there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching our video here on our blog, check out our classes over here to the right, as well as our Market Outlook live trade review videos. You can see all of our monthly subscribers get access to our live trade review videos, as well as all of our trading rooms, our premium subscribers, and you can see the difference between the two up here under pricing in our main menu. If you click on the word pricing, it shows you all the differences there. But the premium subscribers get access to the Q&A sessions, as well as the premium tools and community, including the class. Each class has its own forum where all of our custom content is posted. Also, come down here, click on that heart. It opens up a new window. Hit that like button right there. Also, hit this thumbs up icon. Takes you to your Facebook page. Click on this like button right there. Again, the more you do those things, it benefits us because all of our followers will see our Market Outlook posts, even if they're not online when we post them, because of all the engagement that posts have. It benefits you because Twitter and Facebook will promote content in your timeline from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, back to the charts, and you see the long-term candle we got here. We actually did end up getting a slightly higher high. We did get a higher close and no lower shadow. So again, about as bullish of a candle as you can get. Now, one thing to kind of keep an eye on is the equal weighted index. This is the ETF that tracks the equal weighted S&P. did not get that. So we didn't get a higher high. Last week we did. So a good move last week. We didn't get one this week. We got a lower high. We got a lower close. We got a much smaller body. That's the type of candle that typically leads into a transitionary candle. So just kind of be aware of that. We might be, headed towards, I don't think we'll get a transition candle next week here, maybe yet, but at the very least we could get something, a smaller body. It's very similar to what we saw, because in fact, if you look at the RSP, this is what the regular weekly candle looked like. It was actually a down week. So I can see something like that occurring here on SPX next week. With a much smaller, it might still be bullish. We might not get a lower shadow, but we might end up with a really much smaller body and a lower high point as we start to slow down a little bit. You can see, remember the SPX and NDX, these were so bullish. And look, I've shown you before just how bullish the NDX is on the PPO level. Very, very high. Let's go back to the market forecast and look at the weekly chart for the S&P there. And again, you can just see how strongly bullish the near-term sentiment is and how bullish the intermediate line is. In fact, the intermediate line just barely got in the reversal zone. So again, we might get an intermediate pullback, and we might go towards the 30-week moving average, which is actually in between the 23 and 38. But we're, you're not looking for, we're not going to be producing dark pink shading and a red line here on the weekly chart anytime soon. And of course, the NASDAQ is even crazier, having already got the cluster. But again, you can just see how bullish it is, and how bullish the posture is, and how strong market sentiment still is. Again, we're not going to get dark pink shading and a red line anytime soon. In fact, we could fall to the 38% level here and not get below the pre-COVID high, and be above the 30-week moving average. So that's how bullish the NDX is. On the other hand, the Russell 2000, when we look at its weekly market forecast, it hasn't even turned green. I mean, again, that's how new we are in the long-term trend. So it doesn't mean that we might not get an intermediate pullback here soon, and that's, something like that is likely. But it's not going to be anything more than that. And you can see the 30-week moving average is also between its 23 and 38. And like I said, still hasn't even turned up. And you're actually getting a kind of a bullish intermediate confirmation signal here, but you just don't have the near-term line down yet. Something like this, and here is where the Russell 2000's intermediate line on the daily chart actually did fall, and this was the near-term line. So I actually expect that the near-term line will probably fall here too, and before we get going on a new weekly leg higher. Let's take a look at the 3 green arrow chart. Not surprising, we still have the red arrow on the MACD. I mean, that's always the first red arrow you get, because the MACD falls below its moving average. The stochastics and its moving average is still very strongly bullish. So, and we're still easily above the 8-day moving average. Remember, we're not anywhere. We're not worried at all about even the beginnings of an intermediate pullback until you break the 8-day, and especially until you break the 17-day. And of course, we haven't broke the 8-day yet. We did yesterday at the open, but we closed above it. So we're still, even with falling momentum that's slightly negative, we're still riding a very strong move. If you look at IWM, that's a little different story, right? It has broken its 8-day moving average, still holding the 17 days. So a little bit of weakness there. The Dow Jones Industrial Average, you can see, which has been kind of flirting, at least it's kind of had some correlation with the small cap index lately, at least, which is interesting because this is about as blue chip as you can get. It's not. It's gone back above. But again, look at the equal weighted index, and you can see it for the S&P 500. The 8-day moving average is falling. We've been down below it for 3 days now, and we're flirting with testing, and both the MACD and the stochastics are below their falling moving averages. So now they're still relatively high, so it's not like we're like, oh no, the sky's falling. But you can see the weakness that's creeping in from a broader level than what we're seeing in an index is heavily influenced by this, right? Because remember, the same 5 stocks that make up 50% of this index makes up now 25% of the S&P 500. So they're having a very, and not just those companies, right? You have others like Nvidia and Netflix and Tesla and some other companies too that are at the top of QQQ that aren't like Tesla, not even in the S&P yet. But you can see the influence that those types, as well as other like cloud computing stocks and things that have been so strongly bullish, they're continuing their trends higher, and QQQ continues to outperform IWM to the upside. There's always so much chatter about the rotation trade, right? We were the IWM, for the relative strength of QQQ to IWM had fallen down below 40, even had gotten, as you can see, below 40, but now just so many days later we are right back above 60. So again, don't put a lot of stock into the new rotation trade until we actually break, right? Until we break 40 and stay down there, because every time we've broken below 40 and we just bounce right back up immediately, like within a day or two, and it puts that's the drop that that was the performance of IWM versus QQQ. It lasted a few days, and then a few more days later we're right back above those highs, almost back up to the high that we've had. So this is where the leadership's at, and where it will continue to be, most likely even through the next intermediate pullback to the next run, because again, we are in early stages of a long-term run on risk appetite, fueled by a weaker dollar and fueled by the international stocks, which led off this bear market that we've been in, that finished with this COVID low point. We're just in the early stages of it. But on a long-term basis, so not to be confused with how we're pretty darn overbought in the very mature intermediate trend. But and I got a comment. I got a comment on the last video I did about maybe a little bit cause for concern. I'm not concerned about intermediate pullbacks at all, right? In fact, I actually prefer to have the normal inhale and exhale pattern. I'm actually more concerned when we start to get in the prospect. In fact, the last time I've had a lot of concern about the markets was in January of 2018 when we were bullish, right? When we were really bullish, and I had a lot of concern about how bullish we were. It was January of 18. If you go back to those market outlook videos, we were talking about reducing risk because, as you saw in the chart earlier, we were extremely overbought at that time, and we are not extremely overbought right now. And back in January of 18, the safety trade, bonds and gold, was extremely oversold. They are not extremely oversold right now. In fact, they are still extremely overbought, which is why, again, another sign that we are in early stages of a long-term move, even if we are in a very, very potentially late stage of this current intermediate rally that we're on. All right, let's take a quick look at the intraday charts. And again, you can see the finish up into expiration right at the high. In fact, our high of the 4-week period is almost literally at the end of the day, right before. Remember, the point of control is right below where we're at here. And then you can see the big gap. So when we talked about 335.5, that's the level. That's a really important level to watch. Breaking the 335.5, obviously, and staying below it, because now we start to fill in the gaps, and you can see there's a lot of volume gap as well once you get below this level. A lot of volume gap once you get below the level, because this is going to be, this green dotted line now will be the low of, the brown line is low last week. The brown line will move to that low, to where the dotted green line is. That will be the low of this week. So breaking that low will be pretty significant. And again, you can see the volume as low. I mean, we hit the average, but the average is extremely low. I mean, it's about as low. The average is about as low as it was back here. In fact, pre-COVID, the average was at 62 million. Right now, the average is at 58 million. So our average volume is lower now than it was pre-COVID at the same price. So it kind of shows, again, like we talked about before, this tremendous gap now with historical volatility below 10%. And implied volatility not, right? Implied volatility still is above 20%. In fact, is up at 23%. Even with the drop that it had after this gap up on Thursday, the drop it had all day today, back another week, finishing another week below 80. just a smidge, well, actually a smidgen a little bit above 80. But you can see now it's been 3 weeks closing at extreme lows here. Again, setting up. It doesn't have to be a strong move, and it won't be like this kind of move, right? It won't be even like these here. It'll more likely be just a move up towards at least 90%, if not eventually up towards 100% there on volatility, and that will be the makings of our, once we do get that, and it can happen quick, right? It'll just happen within a few days, and people will go nuts. But we'll know that that's just going to be the beginnings of the intermediate run. Doesn't mean we have to drop every day during the run, during the bearish pullback. It'll just mean that we'll stay down. Like we'll probably break the 23%. We might not even go all the way to 38, but we'll trade within that 38 to 23 for a while as we get dark pink shading and a red line in the market outlook, and then things turn back up again. Right, so all the while that, again, the initial surge will probably get us up to the 100% mark before we, flirt between, using 90% as the low point again before we finally break the 90% on the bounce back up and we start the trend. And at that point, you'll probably see by then a break below the 100% or the 1% ratio here on ATR, because we are now really approaching. The ATR is at 3.55. I mean, we are almost right down to 1%, which is so crazy to think that we were at 6, almost 7% at one point in time. The ATR was, and now, I mean, just for perspective's sake, that's tremendous. I mean, the last time, we had an ATR that was, up at about what, 15% here, or 7. It was up to 15. It was at 7%. You have to go back over here to even the 2011 big drop there didn't even get us above 3%. We were, the 2008 lows got a little bit above 7%. So that kind of shows you, and if I go back to even July of 2002, that was only 4%. So our ATR got as big at the COVID low points as we did at the bottom of a Great Recession. So again, kind of another sign that this was the ending of a bear market, not what a lot of people thought was going to be the beginnings of one, because that's not how, the beginnings, even the beginnings of this bear market occurred. We peaked on the S&P right here, and we failed at the 200-day moving average over here, right? That was the end of one, not the beginning of one. So what do you think of that technical outlook there? I kind of summarized that there as we were going through those last couple segments. What do you think of that outlook? Do you agree with that? Do you disagree? Comment down below. Either way, especially if you disagree, comment as to why. What are you seeing, indicator-wise, chart-wise, whatever, that suggests why you either are a lot more bullish than I am, or that you're a lot more bearish than I am. And I know there's plenty of people out there that have their opinions, but would love to see what's driving that opinion from a kind of a factual standpoint. So share with us what's driving that, whatever chart or indicator that you're seeing in the comment section with the rest of our market scholars community. All right, now let's take a quick look at what's driving the price action here today. So give me 1 second to pull up really the week that was, and you can see the strong move higher. In fact, look at the discrepancy here from IWM to QQQ. From this point, QQQ goes up and up and up and up. IWM goes down, down, down. And emerging markets are kind of up and down, and the S&P is kind of up and down. Developed markets are down. Gold is down. Commodities is down. Real estate is down. The only things that really are up are the dollar and bonds from this point going forward. So if I were just to take a look again at just this week that was, so August to the beginning of the week, go 15 minutes here. And again, small cap stocks started up higher with the Qs, even if it didn't go as high, but the Qs kept going higher all week long. And everything else went down all week long except for bonds. Bonds underperformed on the first day of the week, and then they rallied the rest of the week. And so it's kind of interesting to see the biggest winners this week were, at least outliers from the group, were the Qs and long-term bonds, right? Which means that yields are still strongly bearish or strongly bearish here. If you take a look, remember how we kind of had a good week here last week, a little bit of a transition, and we did end up getting a relatively bullish candle. But you see that red line because this is what the actual candle looks like. We dropped back below the 50-day moving average, and to kind of give you an idea of like next week's candle started at 6.3 and we're barely at 6.4. So just like that, like we've kind of lost the momentum that yields were kind of getting. Now you can see again, yields are still like the 50-day moving average is still 35, almost 36% below the 200-day moving average. The 200-day moving average is still at 1%. We haven't been at 1% on the yields for weeks, months for the 10-year, and that's what the 200-day or 40-week moving average is. So there's still like, again, this isn't the sign of a for some perspective, going back to the 2008-2009 time frame, because remember at the time that was the low point, right? So we consider this being so extremely low, but at the time before before 2008, that was such an extreme, right? Because we had kind of broken down and retested that low, bounced and broke through it. It's kind of the same thing here. We retested the low, bounced, broke through it, almost exact same type of pattern that we saw during the financial crisis. Because it looks a lot higher, but again, on that time, that was so much lower than we had ever seen yields get, because that was like the first time in history, or for a long time in history, that yields the overnight rate was at 0%. So it really brought down the 10-year to an extremely low levels. But again, so we see a very, very similar pattern here. And remember, stocks off of this low point rallied. That's where and all these times that yields took off from these low levels, stocks had really, really good returns. So it's like, okay, are yields really low or are they really high, right? Are we, forming a low point here? The PPO would suggest that we are in the midst of forming a low point. See, remember, the stock market we hit this low right here, but the stock market didn't produce a low point until a few months later in March of 2009, right there. So, and yields had gone up. The PPO was already rising by the time. And again, that doesn't seem such a big deal now, but it was such a big deal back then, because that's about as low as we had ever seen the 10-year. I mean, if you go back, all the way as far back as we can go, you can go back to the 90s. That was as low as we had seen it get. And then you can see we got that low again during the credit downgrade. So that was pretty significant. And then we got that huge divergence in 12 and started this big, long, bullish rally in risk appetite. Same thing after this global slowdown that we had in 15 and 16. So, we're kind of seeing that here. A few months later, after the COVID low, PPO's rising, and it's, are we closer to the beginning of a bear market? Or are we closer to the end of a bear market? And obviously it seems like we were much closer to the end of a bear market, considering how much yields have dropped, especially again in the fall of 2018 is when the safety trade really kicked into gear here. And we see the same thing with gold. You can see gold still very, very high. In fact, if you take a look at the weekly market forecast chart for gold prices, you can see we are coming off of a weekly cluster, and you see the little bit of a rounding pattern here. On the other hand, you can see, again, commodity prices, especially if you look at DBC, just barely, again, we're just kind of getting going. Again, not the sign of a, again, go back to late 2018. Remember, commodities lag. So by the fall of 2018 is when commodities peaked, and then since then, again, that's a bear market. We went from 18 all the way down to 10. That's a bear market right there. That we don't see, because if you go back as far as we can, the 2010. You can see again the credit, that from the mid of 2014 through 15 and into early 16, during this global slowdown that we had, all these kind of quote unquote bear markets have been masked by what you're seeing here. And let me put on a left scale, so I'll do a comparison is what I wanted to do, a comparison chart, and then we'll throw on NDX instead of SPX, right? And then we'll do the we'll just do without the left axis. And see, that's the difference here. Let me make sure I keep the studies in. There we go. That's the difference, right? Here, let me get rid of this. Okay, that's the difference. See, from that point, we had these two bear markets, so to speak, in commodities, and during that time, we just kept going higher in the Qs, and so this return and this gap is kind of masking the fact of how weak we've been globally and how weak we've been across multiple asset classes, and how still low we are, and for that matter, how high we are in other safety trades. So a sign that we are closer to the end of a bear market than we are the beginnings of one. Now let's take a look at the sector, quickly, the sector comparison and how they performed here this week. So we'll go to August, and we'll go to the 15-minute chart there. And then you can see here again, very kind of pro-dollar trade. Because materials, energy, financials, industrials, all down. All these cyclical areas that are economic growth sensitive areas, industrials and materials, down on the week. Financials, of course, with their link to yields, down on the week. And energy, again, economic sensitive areas, down on the week. On the other hand, technology, discretionary, communication services, they've been the leadership. They continue to be the leadership. Any strength that we get, any trend following we get, again, even through what will most likely be an intermediate pullback, you would expect on the subsequent bounce and new leg higher that they will continue to be the leadership higher, and these areas will continue to struggle. And I think that's kind of the issue right now with our economy. It's going to have a struggle getting going, and these are all more tied to economic conditions and expectations than the FANG type and technology type names. They've got, especially with the type of economy that may come out of this versus the type that we had going into it, which is why there's why so much buying is being pulled forward into those spaces. Very, very similar to the late 90s. Whether or not we are in 99 right now or 98 or maybe even 97, even if we are in 98, coming off of a low like we did in the fall, kind of early fall of 98, that was still another 18 months of really strong gains before, and for that matter, almost 2 years before the S&P finally peaked in September of 2000. Of course, the NASDAQ peaked earlier in the year in March, April-ish of 2000. All right, so for our trade idea of the day, I want to take a look in that consumer discretionary space, kind of a consumer staple, discretionary. Obviously, that is Yum Brands, a restaurant company. You can see it's just barely started, so it did get dark pink shading and yellow line or red line in July when probably the whole market should have. But it, in fact, it even got an oversold cluster during that period. Has been re-engaging in new intermediate trends since. And after a little bit of a false start and a pullback with light pink shading, and still staying with the market sentiment, which actually is still falling, we got a cluster. So, a cluster at the beginning of a bullish intermediate run is a great sign. Obviously, nothing's 100%, but if we're going to look for an opportunity that this stock could trend for a little while, that's one sign that suggests it can, even if potentially the broader market has more of a shakeout. If you take a look at where it's at in terms of its point of control, we are almost right there. So this is a very key level right below 100 for it to get above and then get back up to these pre-COVID highs. Now keep in mind that it's pre-COVID, its high point wasn't before COVID. It was actually earlier in 2019, in September of 2019. It's been on a downward trend that just from 120 that exacerbated down to below 6. So it lost more than 50% of its value on this COVID level. But obviously, you can see on a 3-year basis, we're now getting to the top of the value area with the potential of pushing out. You can see it pushing the upper Bollinger Bands out. A lot of good developments on these other oscillators. The DMI is back above 25. The negative directional index is well below 20. The ADX is just starting to rise there. You can see from an Ichimoku cloud perspective, we are still relatively close to the cloud. We haven't really pulled away. There's not a very big gap. See how skinny the cloud is. When you get a good trend, you get a good move higher. Because remember, this is plotted, so many days away. When you get a good move higher, the cloud widens out. We have opportunity for the cloud to widen out, and you have a strengthening trend strength indicators, which have been really noisy this whole period. So you have an opportunity for a little bit of a breakout type pattern to occur. So with that being said, let's take a look at its options and say, okay, well, what if we were to come down here and sell the 105 call option and buy the 100 call option? The spread's a little wide. So what we're going to do here is position size around 400. If we can get out with less, that'd be great. With the wider spreads, it makes it a little bit more difficult. So we'll position size around this full maximum loss and be able to get about a 4-to-1 reward to risk ratio at the worst case scenario. Obviously, if we can get out with half of that, then it'd be an 8-to-1. But potentially up to $1,600 reward if we get up through this 100 level and get up into 105 or higher by October. So giving us a little bit more time to work with because of the this expected weakness that we might get in September and late August and September. So it'll give itself to work some of that out and be able to continue to make its way higher. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on marketscholars.com. That's actually part of our free subscribers get access to those. Open up any new thread, reply to anybody else's thread, and let's keep this conversation going here in the forums. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between videos from day to day. Join our community at marketscholars.com, as well as our Facebook group that we have. Have a great rest of your weekend, everybody, and we'll see you all next time.